Hello and welcome to this week's Market Outlook webinar with me, David Jones, and Aondo Markets. This is a webinar that we do every week on a Wednesday lunchtime at 12:30, and if you're watching the recorded version, it was held live on Wednesday, the 3rd of May. It's a bit of an odd couple of days because this evening at 7 o'clock we got the latest interest rate decision from the US Central Bank, the Federal Reserve. And then, of course, on Friday, as it's the first week of a new month, we've got the non-farm payrolls, the US unemployment numbers at 1:30 UK time on Friday. And I think it's expected at the moment, it's forecast to show something like 180,000 jobs were added in the US economy last month. So that does mean, I think, with the Fed tonight and then the payrolls on Friday, that we could have something of a quiet couple of days until those announcements are out of the way. But there's still a few things to look at in markets. There's a couple of FX markets breaking out, even though sort of stock markets have been a bit quiet. So we'll take a look at a mix of all of these things. And as usual, on this webinar, what we do now is we take a look at a different strategy or trading sort of technique every week. And this week, we're going to look at, I think, what's quite an important one. We're going to sort of move away from looking at signals and stuff like that, but we're going to take a look at when to move your stop loss. I don't think there's a perfect answer to this, but I think it's a mistake that many of us make is moving it too early. So we're going to spend a little bit of time just talking about the theory of that and looking at some real examples in real markets. But let's have a look at a couple of markets first of all. So we're going to start off with this one here. So what you've got on your screens there, this is euro against the dollar. So we're using Aondo's Trade Hub trading platform. So I think what's interesting here, we had those big moves last week on Monday last week, or Sunday night, Monday morning, after the French presidential election. We saw quite a bit of relief in markets as a result, when we saw stock markets and the euro higher off the back of that. And it did mean that we saw the euro break out, you can see here, to its best levels since November last year. And I think always the test when something like that happens is, can it hang on to these gains, or does it just immediately give it back, or give it back over the next few days? And we have seen the euro hold up here, so it's quite a major break. I think, saying that, we did see a break back here, you can see in March, where it poked out briefly to the old highs, but it did give it up pretty quickly. But you can see the moves here over the last 5-6 days, we have managed to hold on. So I think for euro dollar, we are still in something of a buy the dips mode. If I scroll back, here's a 30-minute chart we're looking at here. That was the surge on the Sunday night. But you can see there's been a lot of support from 108.20 through to 108.60. At the moment, we're about 50 points above that if we flip it to an hourly. But it does suggest there's still, I think, the appetite to be a buyer of dips on the euro. It has sold off a bit over the last 10 hours or so. It's pulled the RSI close back to oversold, but there does seem to be an appetite for being a euro buyer still, I think, while these levels hold, these sort of post-election lows, 108.20 to 108.60, I think is a big area to watch. Of course, the pound's been moving as well. When I look at pound against dollar, then when I look at sterling yen, because I think that's an interesting one. So pound against the dollar, we saw this break just over a week. It was the same night. It was on the election night, wasn't it, where we saw it break out to its best levels since October. And October, of course, it was traveling in the opposite direction. We had that flash crash that pushed it down towards the 120 mark. But the pound's now trading 129.25, so levels we haven't seen for about 6 or 7 months. And again, I think, like the euro, it's a bit of a theme of dollar weakness, I suppose. There still appears to be the appetite to be a buyer. We've seen maybe some choppy trade over the last few days, but major support at 127.50, which is about 170 points away from where we are now, and sort of shorter term support emerging over the last week, 128.10 to 128.70. So there does still seem to be an appetite to be a buyer. I think if we saw it break 129.60, because I'm sure there are still people out there who feel that this move has been overdone, there'll be plenty of people who would have gone short into this strength. I think if we see it manage to break these highs from the 28th of April, through 129.60, 129.70, it could set up, I think, another surge higher. But I think, following this break now, for me, I mean, the medium-term target, has to be a run back up to these old highs up here, around about the 135 area. We're not going to do it in a straight line, but I think we've got this trend that's been in place since the March lows. We've broken out through these highs. It does suggest something of a shift in sentiment, I think, for pound against the dollar compared to what we've been used to seeing, for much of the time since the EU referendum. Just one quick one. Let's take a look at sterling yen, then we'll talk a bit about strategy. This has been interesting. I must admit, this would have wrong-footed me because we had the move down here. Let's just plonk maybe a horizontal line on there. Here we go. So we did have, during April, it broke below the old lows. So we had the lows from earlier in the year in Jan, just ahead of the 136 mark. It did break below for one day and then reversed pretty sharply. And since then, it hasn't looked back. Since that move, it's put on something like 900 points sterling against the Japanese yen. It's still strong. If you look on the hourlies today, I think it just, was it yesterday? Yeah, just yesterday it poked out to a fresh move, a fresh high for that up move. So it does still appear to be, plenty of momentum behind sterling yen. It's had a bit of a sell-off earlier this morning, 7 o'clock this morning, but the buyers have come back out. So for sterling yen, it's probably, I think, that the clearest trend, one of the clearest trends we have for sterling at the moment. Look at that, and that's since that false break we had briefly below 136, and the market has just gained ground. So there does appear to be, a bit more headroom left, and it'll be interesting to see if we can get back up to these sort of 148 highs from the end of last year in December. Let's take a quick look at some strategy though. So the strategy thing that we're going to cover today is all about when to move your stop losses. And as usual, I'm going to do some scribbles here. So just bear with me while I bring this up. Assuming this is all going to work okay. Hang on a second. Because I think we all know that we should set stops. And not setting stops, it's not a recommended approach. But I think one of the problems that plenty of us have is just moving them too early. So let's go through, I think, a theoretical example. Let's say a market has done something like this, hits a low, comes back to it, hits a low again, and that's it. So there's our level. So let's say we've bought in, let's pretend it's pound against the dollar, and let's say we've bought in at 128, and we'll pretend that level there is 127.70. So we've bought in 30 points above the level. We decide to give the market a bit of wiggle room, and to make the maths easier for me, we'll put our stop loss at 127.50. Okay, so we've got a perfectly sensible trade there, where the market's hit a low, it's come back to it again, the buyers have come back in, so we're seeing this as a sign that sentiment's changing ahead of this sort of 127.70 level, and we think it's going to be good support, and we could get a half decent rally. So we've got our 50-point stop loss in. Let's assume that the market does what we want it to do and pushes a little bit higher and starts trading at 128.30. So happy days, we're in profit by 30 points on the trade. And this is where trading psychology comes in, because I think the classic mistake that your new, or maybe not so new, retail traders make is to take profits too quickly and let losses run. And there was some work done by a broker a few years ago. I think I might have referred to it before. It's on my website from a couple of years ago, where they looked at millions of trades that their clients did, and they were actually, the clients ended up with more profitable trades than losing trades. But the problem was, the reason why most people lose, the average profitable trade was only half the size of the average losing trade. So if someone was taking profits of 50 points, they were letting trades go nearly 100 points against them. There's no way your account is going to go up with that sort of approach. It's almost death by 1,000 cuts. And I think one of the problems is that we all, in the beginning at least, want to snatch a profit. So we have a market here. Let's take this trade here. So we're 30 points in profit. what do you do? I would suggest you don't do anything. When you first put the trade on, when you bought at 128, you had a stop loss at 127.50. So you are happy to risk 50 points on the trade. So if you're happy to risk 50, it seems a little bit stupid to sit there and snatch at a 30-point profit. And I'd also suggest it's maybe a bit too early to think about moving your stop loss, because let's say, because a common approach I think for plenty of people is to move the stop loss to break even. If the trade starts moving in their favor, they want to move the stop to break even. And I'm not saying that's wrong for everybody, but I think it is wrong for most people, because let's say you move your stop to 128, the market's moved 30 points in your favor. The market can easily fall back 30 points, take you out of the trade. You haven't made a loss, so you're maybe happy about that, but you've given up what could be a good position. The market might drop 30, 40 points and then go on in exactly the direction you thought of. So for me, it's having a rule of thumb about when to move your stop loss. And I've got a couple of ideas. There's a couple of approaches I use, and I've shifted to a slightly different approach in recent months. But for me, I think first of all, if I'm happy to risk 50 points, I want the market to move at least that distance in my favor before I think about moving my stop loss. So I'd want to see the market, in this example, at 128.50. And then I'd think about moving my stop loss up towards the break-even level, okay? Because I'm risking 50, so I want to see the market move 50 points. Something I've started doing recently, because again, I still found out that on lots of good trades, I'd move the stop to break even after it had moved that distance, and I'd still end up getting stopped out of good trades. So I've just really given the market a bit more leeway now, and so for me, what I want to see is the market move 1.5 times my stop before I move it to break even. So for me, in this example, if I've got a 50-point stop loss, I want to see the market at 128.75. Okay, so 1.5 times the stop, then I'll move my stop loss to break even. So what I do is, I don't have to sit there and watch it. I've got a couple of trades open at the moment. I've got a trade on Euro Sterling, and I've got a trade on the dollar index at the moment. And what I want to see, I just set up alerts. So if my stop loss on Euro Sterling was maybe 60, 70 points away, so the market, I want to see Euro. I'm short Euro Sterling, so I want to see Euro Sterling fall. If my stop loss is 60 points away, I've got an alert set. If Euro Sterling falls 90 points away from my entry point, then I'll move the stop loss. And I think it's a really important consideration, because you don't want to be in a position where you're snatching at profits too quickly, because you'll be in that situation that the vast majority of traders are, where your profits are just not as big as your losses, and you're just not going to be profitable. And the other thing is about, you don't want to be in a situation where you're moving your stop to break even too quickly and getting out of otherwise or would have been profitable trades. The market doesn't care that you only want to use 30 points. You need to give the market, in my view, quite a bit of leeway to move in your direction. There's a couple of questions coming in, so I'll answer them in a sec. I'm not ignoring you. So for me, in this example here, when the market moves to 128.75, then I'd start moving my stop loss, and then it's all about trailing it up. If I'm buying at 128.00 with the stop loss at 127.50, so 50 points away, my target ideally is going to be a multiple of that. So I might be looking for 129.50 as a target. So I've got 150 points potential profit for only 50 points risk. So then it's a question really of trailing that stop higher. As the market gets closer and closer to my target, I trail the stop up behind it. Because if the market gets to 129.00, for example, I think it would be silly to have my stop loss still at 128 at that point, because I've got 50 points to go to my target, but I'm risking giving back 100 points of profit. So I might move my stop up then to maybe 128.70. So I'm 30 points behind with 50 points to my target, and then trail it up. But I think the important thing out of this, we'll cover trailing stop losses and when to trail them on a future webinar, but I think the important thing here is don't be too keen to move your stop loss at the beginning of the trade. They'll come up with something, some plan. Whether it's got to move in your favor, the distance of the initial stop, or some multiple of the distance stop. Come up with something that makes it maybe a bit more mechanical and takes the fear and the psychological aspect out of when to move your stop. So someone's saying, okay, just a question on the FTSE. We'll come to the FTSE in a sec, but with the pound recovering, how you think the FTSE will behave over the next 3 to 6 months? Well, clearly, you're right. It's a good question because it's bad, isn't it? Technically, it's bad for the FTSE 100 companies as if the pound continues to strengthen, because so many of them are international. And we've seen it. I think we've seen it in the last couple of weeks with this pound strength. It has put a bit of pressure on the FTSE. We'll come to stock markets in a minute, but I don't think the next 6 months for stock markets are going to be like the last 6 months. We've had the Trump bounce, and I think markets are looking a little bit overextended. Saying that, the DAX just yesterday pushed out to fresh all-time highs. But I think if you look at US markets and the FTSE, which we'll look at in a sec, I think the markets do look a bit overextended, and that strengthening pound is definitely not going to help the FTSE. Do you have multiple trades on one pair? That's a good question. You buy against the dip, it goes against you and dips further. You buy again, believing in a reverse. For me, I wouldn't have. So if I've got a fixed level of risk, let's say with a 10 grand account, let's say you're happy to risk losing 3% on any one trade. So you're happy to risk losing 300 quid. If I've got a trade on where I've got the risk on, euro sterling, unless I've got my stop at break even, I wouldn't do another trade on that market. So I wouldn't do a trade where my stop means I'm risking losing 300 quid, and then do another trade where my stop means I'm risking losing 300 quid because the market's moved to a better position. I'd take the view that I'm just doubling up my risk. So I'd happily run multiple trades if I had a stop loss at least at break even, or I was buying into a trend that was going in my favor, but I wouldn't add to a trade where the market was against me, if that makes sense. So hopefully that answers that question. But I think hopefully there's a bit of food for thought there when it comes to setting stop losses. Just to think a bit more. Don't be too keen to move them too quickly, because it can end up taking you out of trades that would otherwise have been good trades. Let's get back to the market. So euro dollar's broken out, pound against dollar with the breakout in the last couple of weeks. Sterling yen that we looked at still looks strong, but I think maybe one of the clearer breakouts we've seen has been dollar Canada. So the dollar Canadian dollar. Here we go. So let's take that out. And this is always an interesting market to watch, I think, because of the trends that we do see. So I've taken this is a big picture view of dollar Canadian dollar. So we'd had this fantastic run up through 2013 through to 2016, beginning of 2016. Then we see the market giving it up, dollar sliding, and since then the story has been of the dollar building it back up again, and it's moved out over the last week and a half to levels not seen for, it's a year, isn't it? So it's 12 months highs, dollar Canadian dollar. So whereas the dollar against the euro and the pound is in retreat, it's still strong against the Canadian dollar. So for me, it definitely looks like a buy the dips market. This is an hourly chart that we've flipped it over to now. So this is the last month or so. So if we're going to draw our trend line on here, it's going to look, I don't know, something like that, for example. And you can see well within that trend. So for me, we've seen a bit of weakness today after pushing out yet again fresh 12-month plus highs yesterday, dollar Canada. So for me, if we saw it sell off, back towards this sort of area, 136.60 sort of zone, and then the strength come back in, it would unwind the RSI for the fans of the squiggly lines. And the RSI has not done a bad job of calling the turning points whenever the RSI has moved towards its extreme. So I think if we did see a sell-off, it looks like I think another good buying opportunity, I think, in dollar Canada. So I think that's an interesting market to watch, I think, the next couple of days. That is a market that is, like sterling yen, is still actually moving. One last FX market, then we'll take a look at some of the stock markets. So what we're going to look at is dollar yen. I was thinking about going short this last week, but would have been a little bit earlier. It did falter for a bit, but it's still recovering off these lows from the middle of April. So if we were to plonk our trend line on dollar yen, downtrend. So that's the trend it's been in for all of this year. It's broken through this old resistance around about the 112 mark, so it still looks to be strong. But we've got the downtrend coming in around about 113. So I think dollar yen's an interesting one, another interesting one to keep an eye on. You know, the RSI, for the fans of the squiggles, is heading towards that extreme area. And again, it's not done too bad a job at calling the turning points over the last 6 months or so. So I think we're really waiting to see this trend, particularly I think on the hourly charts, start to run out of steam. I wouldn't want to be short yet dollar yen because it was only yesterday it made a new high for this trend, but I think that's another one to watch just because we're coming up near that downtrend line. So we'll see how much of a problem the 113 area is for dollar yen. I think that's a good one to watch over the next couple of days. And clearly we could see potentially lots of fireworks for the dollar over this Fed statement tonight. Let's see what they come out with and what they say about their outlook for the US economy. But that's 7 o'clock, so I think maybe take a look, if there are FX pairs you're watching, take a look at them about 7:30, 8, and see how they've reacted to this. Let's take a look at stock markets. Let's start off with the DAX, because the DAX just last night, are we on a daily chart? Just last night broke out to fresh all-time highs. I think it was it's been doing it over the last week anyway, again off the back of the French election. But you can see this is a weekly chart we're looking at now. So around about, I think, 12,400 was the previous high from 2015, and we're through that. So even though other stock markets have been pretty boring, I think, over the last week or so after that election surge, the DAX has continued to push higher. So there's our daily chart on the DAX. Let's flip it over to an hourly to get a bit of a. There we go. There's our election surge, and you can see it's been pretty scrappy trading since the surge, a little bit sideways, and then pushes higher last night in sort of out of hours trading after the market had officially closed. But you can see, you know, plenty of support ahead of the 12,400 area. So I think that's another interesting one to watch. The fact it's managed to break out to all-time highs, even though other markets have been a little bit boring. So sticking with other markets, I think the US stock markets, as usual, are going to dictate the next, you know, few weeks, few months for every other stock market around the world. And I think what's interesting for me is we had the French election surge again last week. Hang on, what's that? This is the Dow we're looking at. Let's look at the dailies on the Dow first of all. So the French election surge last week, the previous all-time high was just up here. Was it end of Feb, beginning of March? That was the all-time high for the Dow, around about 21,200. It came close to it last week. I think it came within 100 or so points, but hasn't actually broken it. So I think it's a really big level to watch, and we can see it's just sort of drifted off. So I think it's going to. What happens if the Dow rallies back up to here? I think it's going to be a really big deal. I think if we can break through, so we've got the highs there, 21,170, near enough. I think if we see it trading through, then again, plenty of people who've maybe bet that it's time for the rally to end are going to be proved wrong. So we could see quite a bit of short covering off the back of that. But again, if you really thought, well, that's it, the strength in US stock markets has been overdone, it's another good opportunity to get short up here, because you don't have to risk too much. Because for me, if it breaks out to these old highs, that's it. We could well be off to the races again. But I think it's interesting that it hasn't really built on that surge. You know, the last couple of days of last week, so far this week, it's been really quiet trade. And I think we'll see that. We could well see a bout of volatility over tonight's announcement, but then probably a quiet day tomorrow, and let's see how it reacts over the payrolls. But I do think it's one to watch. I think these US stock markets, you can see, there we go, look how dull it's been. So this is an hourly chart we're looking at. Look how tight the ranges have been. But let's see if it can take out those previous all-time highs. I think that's really the big level to watch. Have a quick look at the S&P, which is my favoured market. It's a similar sort of story, of course, on the S&P. So the S&P 500 we had the election surge. It had a look at those all-time highs just above the 2400 mark, but hasn't managed to break through. So for me, I wouldn't. I'm a bit, but I'm maybe talking my own book here as well, because I've got to trade on the S&P. But I do think that it wouldn't be surprising to see it come back down to maybe the bottom of the recent range, unless they come out with some absolutely stonking, I don't know, stonking news tonight, the Fed, and sends the market rocketing. I just think these markets are starting to look maybe a bit overextended, but I would completely throw that opinion out the window if we broke out to fresh all-time highs. But I think it is interesting up here, but we may have to wait a couple of days, I think, before stock markets get properly interesting again. Oh, someone's just said a reminder that margins go up this Friday for many brokers. Yes, they do, because it must be is it the French election round 2 this weekend? So I think plenty of sort of spread bet and CFD brokers are putting their margins up on Friday. So if you have open positions and not much leeway in your account, you might need to put a bit more money in, because the margins are going up ahead of what they perceive to be could be, and again, another volatile start to trading on Sunday night. The last one we're going to look at, which I think again for me is maybe one of the more interesting ones at the moment, is the price of gold. I think my expectations for gold this year, has been for it to gain ground and to continue its recovery, and first of all have a run back up to those old highs from last year, around about the 1370 mark. So for me, I would be a buyer of gold on dips, and I think this is being borne out by the chart. The trend we're seeing from December last year. Here we go. So there's our chart. There's our trend from last December. So that it's come from around about 1130 an ounce, currently trading at 1250, but being almost up to 1300, and it's doing everything at the moment that an uptrend should be doing. It pushes up, sells off a little bit, pushes up again, breaks to the old high. We're currently going through the bit of a sell-off again, but for me, I think for maybe the medium-term traders, I'll be watching gold for the strength to come back in again ahead of this trend line, but more importantly for me, ahead of the old support. So the first level of support I'll be watching will be that around about 1240. So about $14 below where we are now. Looking for signs of a bounce here. We've also got the squiggle, the RSI, the 10-day RSI is heading towards oversold. And again, they did a not bad job last time around on that last dip in March in calling the turn, and we haven't really been oversold. I stayed oversold for a long time during November when the market was just falling off a cliff. So for me, that would be the first level to watch. And if that breaks, then I'll be looking for what happens if we get back here, back towards 1200. But I think the trend for gold for this year is still most definitely up. So I'll be looking for the strength to come back in. And that's it really, I think, for this week. There's a lot, the next couple of days, there's a lot happening that we need to get out of the way until we can return to more normal markets. But DAX breaking out to fresh all-time highs is positive, but we're not seeing that mimicked in the US markets. And I think if US stock markets struggle with these all-time highs, we should expect other stock markets around the world to come under pressure. Euro dollar has managed to hold on to that break, the French election night break. The pound is still strong, but sterling yen looks like the strongest one there. Canadian dollar looks like a buy on pullbacks because it's just broken out to a 12-month plus high. And the price of gold for the more relaxed traders out there, I think is worth keeping an eye on every couple of days or so to see if the buyers come back in. I'll just flick up my contact details. If you have any questions, you can drop me an email. My email address is david@tradeafter.com. I do social trading webinars with Aonda. They're probably better known for their social trading where you can copy other traders. And for a couple of months now, I've been running a real account and putting the details up publicly. I did an update last week. I ended up picking a rogue trader last time round who managed to blow his account up within I think a couple of days of me following him. But because I had the risk dialed right down, it didn't do devastating amounts of damage to my P&L. So you can read the latest update there. That's on www.tradeafter.com. But any questions, drop me an email. David@tradeafter.com is the best one for me. But we'll wrap things up there. I hope you found it useful. Give some thought to that idea about when to use stop losses, because I think it really is crucial. In the early stages of a trade, you don't want to be snatching your profits too quickly or getting the trade stopped out at break even when it would have turned out to be a profitable one. So I think maybe have a little bit of a think about that and make it a bit more mechanical. But it's 1 o'clock, so we'll wrap things up there. Thanks for coming along, and I hope you enjoy the rest of your afternoon.